I wouldn't blame you today if you were confused by all the different mortgage rates. Like we're talking about fixed rates, overnight rates, prime rates, discounts, HELOCs, all this different stuff. It is probably one of the most confusing times ever for a Canadian consumer. Even though you can search all this stuff up on YouTube on a regular basis, trying to get a handle on not only what all of these rates means, but how it actually impacts your financial situation as it relates to mortgages is freaking insane. And I don't blame you if your brain is on fire trying to understand how it impacts you and how to make a decision. So let's walk through what each of these rates means and specifically how they impact you. What is the one that you should actually pay attention to, and what is one that you should not really care about as it relates to your mortgage? Sneak peek, you should care about all of them, but some more than others. Let's get right into it. We'll start with the simple stuff and work our way up to the more complex. So most people don't ask fixed versus overnight versus prime, but they're usually confused because they're having a hard time determining the difference between when the bank says rates are going down, what does that mean for fixed interest rates? Listen, fixed interest rates are determined based on a variety of different factors, and they come in different term lengths, 1, 2, 3, 4, 5, 7, or 10 years. Big factor of how fixed interest rates are determined are based on a number of considerations, but usually the markets. There are a number of different types of graphs that you can find that will help you indicate what is happening in the fixed rates, but in Canada, simply the easiest way to understand the trends of fixed rates is by following something called the 5-year Canadian bond yield. As a Canadian, you can watch this graph to get a decent indication as to where rates could be and where their trends are. Now, banks have their own internal guidelines, which will impact what the actual rate they charge is, and it will be impacted by everything from the amortization period, the lending program, if it's a primary, if it's owner occupied, if you're putting less than 20% down or more than 20% down, because all these different factors actually impact your interest rate. Back to that Canadian bond yield, if you're seeing it go down, typically speaking, the banks will have a little bit more movement to reduce their interest rates. If it's going up, then maybe more. Over and above that, fixed rates are set it and forget it. When you take one, you lock it in and it remains the same. Now, variable rates are when things get really confusing. And this is where all these different rates, variable, prime, and discounts really come into the picture. You see, what happens with a variable interest rate is it's impacted by this prime rate, which is impacted by the overnight rate, which is defined by your discount. So the actual variable interest rate is the end result of all of those different factors. And how it's determined is by something based on a discount. But before we get into the discount, let's go back to the start. So this is where things get interesting. The Bank of Canada determines something called the overnight rate. This is typically what you're always hearing about in the news when you're hearing about overnight interest rates. Think about this as the foundation of our overall system. This is what the bank charges banks to lend money overnight, essentially. And this is the basis of the prime rate. Now, the prime rate goes up or down based on this overnight rate. Typically, what we've noticed over the last couple of years is prime is set at 2.2% above this overnight interest rate. But that doesn't necessarily always have to be tied together. You see, when the Bank of Canada makes a decision, it impacts the overnight rate directly, which can bring it up or bring it down, and typically prime falls up or down depending on the bank's decisions. Every bank, typically speaking, has the same prime rate, except for one, funny enough, that's TD Bank. Who knows why? So now that you know what the overnight rate is, and now that you know what prime is, we can start to get to determining specifically what variable rate that we're gonna get. But hold on, there's one more rate to get there, and that's called the discounted rate. You see, what happens is when you take a variable rate mortgage, you don't actually take an interest rate, you take a discount. For example, if you're getting 0.5% of a discount on prime, and prime is 5.95%, then your actual final interest rate today is 5.45%. So in effect, what happens is this: the bank triggers the overnight rate. And if the overnight rate goes down by 0.25%, your prime has the option to go down by 0.25%. And if prime goes down by 0.25%, then guess what? Now, your total interest rate goes down by 0.5%, from 5.45 down to 5.2%, effectively reducing the total amount of interest you're paying. Have I lost you yet? All right, so that's a lot about rates, but there's a few other ones that you probably want to know about as it relates to your mortgage. Number one, the qualifying rate, otherwise known as the stress test. See, the Bank of Canada brought in a stress test in 2016 and fully connected it to make all mortgages stress test capable by 2018 by any federally regulated institution. How the stress test works is they basically take the interest rate that you're gonna pay, the advertised interest rate, they add 2% to that and they figure out the monthly payment. So when they're trying to determine the total amount of debt that that you can carry on your actual monthly payment. They use that higher monthly payment and not the rate that you're actually paying itself. HELOC rates, on the other hand, are determined, as we mentioned before, typically speaking back to that prime rate. And what you'll find is that a HELOC rate could be prime plus a certain amount as opposed to prime minus. So instead of getting a discount, you get a surplus. More specifically, HELOCs themselves are interest-bearing accounts, which means you only pay interest unless you opt to pay more. And because it's set up like a line of credit, you can pay down your HELOC at any time with no prepayment penalties or extra costs associated with that, which is one of the key benefits of a HELOC. All right, so let's bring this all back together. Let's try to think about this like a pizza. Simple. You have a different slice: fixed, variable, prime, HELOC. All of these are different components that fit together, and they might not all be for you, but they fit together simultaneously and directly have an impact. The thing is, you typically pick up the right slice or the right option, which makes the most sense for you. All right, I'm kind of hungry. I'm gonna go eat, guys.